Let's say you're ready to purchase your first home. You have your deposit and you've found the perfect property. But like everything else, you get cold feet and you decide to sleep on it before making an offer. After all, purchasing a property is not something you take lightly. But you wake up the next day and the price has gone up $1,000. You delay another day, another $1,000. Or your parents said they'll give you the deposit, but they delay sending the money by 2 weeks. And by that time, they send it and you don't want to make an offer. The house has already increased in price by $14,000. So now you can no longer afford that house you want to buy. That's outrageous.
Yeah, and sadly, this is exactly what's happening right now in Sydney, where house prices have soared by $300,000 in 10 months. That's an increase of almost $1,000 a day. Housing affordability in Australia is worsening, and this means it's getting more and more difficult, if not impossible, for first home buyers to get into the market.
But wait a minute, isn't the hot market starting to cool down? In this video, we're going to share with you why housing affordability in Australia is continuing to get worse, even as the market might be starting to cool down a little bit. We'll share with you some tips on how you can buy a property when prices are rising. But before we start this video, if you find it helpful in any way, do me a little favor and hit that like button below or leave a comment for the YouTube algorithm. Just a little gesture like that makes a huge difference to the channel. So if you haven't already, hit that subscribe button below. Thanks you guys, it really means a lot. So let's dive in. Australian dwelling values have rose an average of 1.9% in October, up from 1.5% in August. Over the past 12 months, Australian property values have jumped a staggering 20.3%, causing APRA to panic and reduce the maximum amount households can borrow.
So as you can see, the market's still pretty hot and prices are going up every day. The main reason for this is low supply and high demand. Record low interest rates, lockdowns which have people stuck at home and needing more space, first home buyer incentives, and good old FOMO are all driving up the price of housing and worsening affordability.
Affordability is a relationship between house prices and household incomes. House prices have been rising, but household income growth has been lagging far behind. In fact, house prices have risen almost 11 times faster than wage growth over the past few years. But this has been happening over a long period of time.
For example, over the last 20 years, house prices have grown over 200%, while wages have only gone up by about 82%. In 2021, where the average house price has gone up by 20%, wage growth has only increased by 1.3%.
Of course, the increase in house pricing is great news for existing property owners whose investments are now paying off big time.
But for anyone who's trying to get into the market, it's getting harder and harder and less affordable. But as a first home buyer, it's not the end of the world. We're going to share with you some tips you can use to buy a house even as prices continue to go up.
So what can you do?
Firstly, you need to determine your budget. It's always good to be guided by the market, but it's more important to be guided by what you can comfortably afford. People talk about using 30, 40, 50% of your income. I think it's different for everyone because different people have different costs. If you've got childcare, you can't really get rid of that while you're working. It's a cost you can have ongoing. If you're a single person, can you cut back on certain luxuries to pay for your mortgage? You have to do your own budget. In a market like it is today, you really need to have an upper ceiling for your budget. You can't keep chasing property prices. The best way to do this is look at what you're currently spending a month. Sit down and do a budget and see what is the must and what's optional. What could you cut back if you really had to, and determine how much you're comfortable with using of your total income towards your actual mortgage repayments. If you're finding out your budget can't quite keep up with prices in your current suburb, which we're seeing a lot at the moment, maybe look further out, or potentially look at buying a unit instead of a townhouse or something cheaper. Because reality is no one's income is going up by 20% a year. It's not going to keep up with the market. So if you can't afford that suburb and you want to buy it today, then you might need to look further out.
If what you can afford is slightly less than the crazy prices out there, don't worry, keep watching. 2, talk to a mortgage broker. A mortgage broker will help you understand your financial position and how much you can comfortably borrow from a lender. At Hunter Galloway, we have a thorough process to help determine your eligibility for a loan as well as how much you can borrow.
As part of this process, I'd suggest looking at rates today, but also considering the long-term average interest rates. So just because you can borrow today with interest rates, maybe with a 1, maybe in the low 2s for fixed rates for the next couple of years, it doesn't mean it's always going to be that low. I'd suggest trying out your repayments on a higher interest rate. Try 3 or 4% to see the difference it's going to make. On a $500,000 loan, for example, with repayments at 2% as they are today, your repayments are only about $430 a week. Fast forward to the future, if interest rates were say 4%, the repayments actually go up to $550 a week. So you just need to think about where you're going to find that extra $120 to make the repayments when interest rates eventually do go up.
The next, you only need an 8% deposit rather than actually waiting for a 20% deposit.
With prices rising as they are, if you're looking at say an $800,000 purchase, you'd need at least $160,000 plus your stamp duty to get to your 20% deposit. But there are a bunch of lenders that let you borrow with only an 8 to 10% deposit as long as you pay lender's mortgage insurance. The downside is mortgage insurance can be costly. We've got other videos on this, but it can go into a few $1,000s. But if you're getting property price growth of 1.5%, 2% a month, then it's going to pay for itself pretty quickly. I think the other point here is you always want to have a bit of buffer. Ideally, you want to have some cash left over for when you settle in case something breaks, you need to pay for repairs, or set aside for emergencies.
That said, having a lower deposit is a great way to enter the market and lock in the purchase today. Number 4 is to get a pre-approval or an eligibility letter. Your mortgage broker will help you do this. Having a pre-approval will make you able to put offers quickly when you find the right property.
Different lenders have completely different policies, especially when it comes to certain postcodes, specific type of properties. Even if you're looking at houses near power lines, some banks have issues with that and may want a high deposit if you're looking at properties like that. Recently, I was talking to a young couple that was buying a property in Brisbane CBD. They were looking at a beautiful building, but the problem was the bank actually considered it high density, so you couldn't buy in that building with an 8% deposit. You needed at least 10%. And it was across the board because in that particular building, there was a lot of short-term accommodation. So the banks considered it a little bit more risky than if you were buying a unit in the suburbs, for example. Other things to look out for are your genuine savings. If you've got less than a 10% deposit, generally the bank's going to want to see you holding at least 5% of your savings for the last 3 months, or they would have made sure that you've made your rental payments on time. If you've just started a job and you're in a probationary period, that's fine with a lot of lenders, but not all of them. So just make sure your bank's fine with that situation. It's the same if you're a casual or contract employee. Some banks actually want you to be in the role for at least 6 months now. So chat to your mortgage broker and make sure there's lenders that are going to fit in your situation. Next, find the right property for you at the right price. Not a week goes by where someone asks about the next best hotspot or a place to buy where your property is going to double in the next few years. Show me the money! I think the reality is no one knows. No one has a crystal ball. If you're looking for a home, it's best to look at what's going to be right for you. To work that out, I'd suggest doing a buyer's brief. We'll include the link below. There are literally thousands of real estate listings. And to help avoid wasting time and spending endless Saturdays going to open homes to be disappointed, I'd suggest to create your own buyer's brief to work out what you really want and what the nice to have things are in your future home. The things to consider are the type of property, the property features, the style of property, outdoor features, or even any other deal breakers. For example, if it's on a main road, maybe you don't want to live there. We'll include the link below for you to start working your buyer's brief today.
And the last is to consider rentvesting. If you can't afford to buy a property in the neighborhood or city you want to live because prices are going up, you can consider renting in a more expensive neighborhood and buy a house in an area you can afford. Once you've built up enough equity, you can then buy the neighborhood of your choice.
This was definitely a really popular option a few years ago, where you could actually put in a similar amount of deposit if you're buying an investment to a home you live in. Today, it is a little bit trickier for a couple of reasons. Firstly, in a lot of states, there's stamp duty concessions if you're buying your first home. In Queensland, for example, the stamp duty is waived under $500,000, and in Sydney and Melbourne, there's similar stories at different price points. If you buy an investment property, you're gonna have to pay the full stamp duty. And in a lot of cases, the banks will want you to have at least a 12% deposit plus your stamp duty if you're buying an investment, compared to, like Nathan said earlier, an 8% deposit if it's a home you're living in. So it's worth sitting down with your broker potentially to compare the two options and seeing what sort of price point you can achieve if you're buying an investment property compared to a home to live in, because oftentimes that can be the determining factor.
So what's preventing you from qualifying for a home loan? Here at Hunter Galloway, we get home loans approved. So if you're looking for a mortgage broker and living in Australia, we can help. Visit us online at huntergalloway.com.au and we'll see you next time.